Hello and welcome to this week's Money Roundup, where we start with some headlines that we've been making.
Last week we attended the Schroders UK Platform Awards 2018, winning Best Platform Award for Assets Under Management under 25 billion.
The Schroders UK Platform Awards celebrate excellence and achievement in the fast-changing world of investment platforms and technology, and we're thrilled to see our business recognised at such a prestigious event.
In the US, the Federal Reserve has hiked interest rates for the third time this year, brushing off President Donald Trump's criticism of this policy. The Fed's announcement this past Wednesday saw its short-term rate increase by 0.25% to a range of 2% to 2.25%.
The new range is important because it surpasses the Fed's preferred inflation measure of 2%. It is the first time since before the 2008 financial crash that interest rates have turned positive in real inflation-adjusted terms.
We can see that in real terms policy is getting a little tighter. However, the rate remains below the growth trajectory of the economy, which is expanding by more than 3%.
This slight tightening of monetary policy is a natural response to improvements in the US economic growth, which accelerated in the prior year and is now self-sustaining. Growth is no longer reliant on central bank support.
The Fed are signalling increasing confidence in the economic recovery. They do not see it being derailed by the upward shift, the current tightening cycle, nor the trade wars underway.
Of course, this is an ongoing journey, a journey subject to much discussion and requiring a keen judgment. The Fed are not intent on causing a recession to stop an overheating economy. They are keen, we suspect, to maintain growth for as long as possible. In doing so, they are offering a stronger economy for longer, so measures to help bear down on exceedingly large US spending and trade deficits can be given time to work.
Underlying shifts in the industry prospects are reflected and captured by investors through the stock market, such as the dot-com boom in the late 90s.
At that time, many stocks in the technology, media and telecommunications sectors were soaring to stratospheric valuation price and levels, in some instances without any track record of turning a profit. However, as the TMT theme gained more and more recognition, investors felt more compelled to follow the trend. As we know, this turned into a well-documented TMT sector bust and, along with other associated effects, resulted in a generalised economic downturn.
The objectives thought possible in the internet boom years took longer to deliver than originally envisaged, but some would say these expectations have been exceeded. The emergence of technological change, dreamt of as life-changing, has given us smartphones, tablets and watches as communication devices, to name a few, but everyday items which we take for granted.
Over the last 18 years, companies taking advantage of technological advances have been able to create entirely new and exciting businesses or have used technology platforming to replace workers with computers and learning machines, delivering increased productive capacity. Efficiencies uncovered have helped drive and improve corporate margins. Technology and productivity gains have in turn justified higher corporate valuations in the stock market, with positive effects spilling out to the real economy.
Recently, index providers like the S&P in the US, perhaps mindful of the concentration effect from some high-flying technology stocks, decided to rebalance sector compositions across their flagship S&P 500 index. They shifted 27 stocks from the technology, consumer, discretionary and telecommunications sectors, including Google and Facebook, into a new supercharged communications sector.
It is interesting that the technology sector, before the rebalance, accounted for more than 25% of the index, not reaching the peak of 29% back in 1999. The rebalance drops the sector weight to 20% and perhaps heads off the possibility of criticism in future years that the mistakes of the internet years were repeated.
Previously, the telecom sector was the domain of traditional industry and so-called defensive companies. However, it will now include many more high-flying companies like Facebook and Alphabet, formerly classified as tech. For more on these stories, read the blog at blog.tpinvestor.com and subscribe to the True Potential Investor YouTube channel.